Hey, welcome back. Have you been out looking for homes and you're not sure if you should be saving 20% down or taking advantage of an insured mortgage product using a company like Canada Mortgage and Housing Corporation, also known as CMHC, or Sagen or Canada Guarantee? Well, we're going to get into that today, but before we do, make sure you hit that subscribe button, smash the notification bell so you can continue to get all of our great real estate videos. While you're there, do me a favor, ask all of your questions. Any of your real estate questions, your mortgage questions, your housing market questions, go ahead and drop them in the comments section and we'll answer them almost right away. So let's jump right into it. What are the pros and cons of using a insured mortgage or a conventional mortgage? Let's start out with what the heck are the difference? So when we talk conventional mortgages, this is a mortgage where you are putting down at least 20% of the purchase price of the house. When we talk insured mortgages, what we're doing there is when you're putting less than 20% down, so as little as 5% down, a company like CMHC or Sagen or Canada Guarantee, they're going to come in and they're going to protect the lender. So they're going to take care of that in case there's any default. They guarantee the value of the home and they protect the lender in that case. So in those instances, CMHC, Sagen, Canada Guarantee, they've got some different programs, but they are very strict to those guidelines. So any of those guidelines that they have, you need to make sure that you're able to satisfy a lot of those. Now, what does this mean for rates? So in a lot of cases, it doesn't make a lot of sense to most people that if you're putting more down as a down payment, the bank's taking on more risk, right? So if you've got 100,000, maybe 200,000, maybe even more saved for a down payment, versus somebody that's only scraped together 5%, you're going to pay a little bit higher premium on that interest rate versus somebody that's putting 5% down. And the reason for that, it's really, really tough to explain, but the government made some changes about 7 or 8 years ago that stipulates how banks are able to lend out their money on the back end, and how they're able to invest their money. And it does make it a little bit more expensive when they aren't using an insured product. So they pass that cost onto the consumer. So when you are buying with a conventional mortgage, your interest rate will be slightly higher. Now, when you're seeing a lot of those rate sales, so sometimes you'll see a rate sale where, 5-year at a crazy low rate, and a lot of those competitive markets, those are going to be insured mortgages. So don't always get hooked in that, hey, I saw this great rate with whatever lender it might be, and think that you can get that on all deals. A lot of times, the lower rates carry the higher cost of borrowing. So when we're buying it, let's start with when you're buying a house with 20% down. So we've got that 20% down. What are some of the pros? So obviously some are very simple. One, you've got more equity in your home, right? When you have more equity in your home, you're going to have a lower borrowing cost. Your mortgage payments are going to be a little bit lower. And if you need to refinance or you need to, as you continue to grow, you've just got more equity there. There's more flexibility when it comes to qualification. So if you're self-employed, maybe you've got extended ratios. So we want to make sure that your ratios are within a certain percentage of your income is going towards paying off all of your debts. CMHC, they have different guidelines that need to go by. Sometimes we can get a little bit extended on that conventional program. Maybe if your credit's a little bit, we got some bruised credit programs. A lot of those conventional options, they do bring up those alternate opportunities for you. Some of the cons of that conventional mortgage, really only the one is sometimes it's a higher initial out-of-pocket cost, right? So what I would suggest is if you have the 20% down, get into the market, right? Use the 20% down. If you don't wait to save the 20% down. Right. So one of the things we've seen is I've got personal friends of mine who have been waiting 3 years. 3 years ago they had a townhouse they really, really liked, but they only had 15% down for a down payment. Instead, they decided they were going to wait a year, save that 5%. Well, what's happened is the market doubled and then it doubled again, and they're completely priced out of that market. And now they had 15% to purchase, 3 years ago. Now that same money that they have saved and a little bit extra they're down to 10% because the value of that house has continued to go up and up and up. So one of the things I would say is don't chase the down payment, right? If you have enough to buy with 5 or 10% down, maybe even 15% down, don't be afraid of CMHC fees. Most first-time homebuyers have to use those fees. The other one where we see it sometimes where you're not a first-time home buyer is if you have high debts. If you have credit card debts and you want to pay off maybe some car loans, you want to free up some of your monthly cash flow. Sometimes at that time, it's worth it to go into that CMHC insurance and pay off, high interest credit cards, the 19%. Maybe you've got that, like I said, that car loan, some of those things that are there. So let's jump into what are CMHC insurance. What are some of the pros of that CMHC insurance? Well, for starters, it is a lower down payment, right? As soon as you're able to purchase that house, if you've got that 5% saved, it's a little bit easier to save the 5%. If you're looking for ways to how do you save for your down payment, we've got a video all around that. So if you haven't seen our how to save for a down payment video, maybe go check that out. Like I said, 5% down, a lot easier to come up with. Don't be afraid to ask family members too, right? Sometimes we see family members, even grandparents, sometimes using a reverse mortgage program. Our friends over at Bloom have a great reverse mortgage program where they allow grandparents to let their kids or their grandkids see what some of the money that's going to be left for them anyways. And sometimes it's a little bit easier to ask, hey, can I borrow, can you give me 5% down versus getting to 10 or 15 or 20% down. And sometimes it's, it's given to them as a gift. But sometimes that when you sell that house and you've gained that equity and it's continued to go up, now they make that payment back. Like I said, some of the other pros, the interest rate is going to be a little bit lower. It's a very, very competitive space. So a lot of those lenders, they do have deeper discounts on those houses. I said the other one, potentially gain entry to the housing market a lot sooner, right? The sooner you get into it, it's not about timing the market, right? It's about time in the market. The sooner that you can get into the market, the better you're going to be, right? You are going to start participating in that equity growth. When is the best time to buy a house? Never in history has anybody said, I wish I didn't buy that house 5 years ago. Sometimes when we look year over year, there are some little dips. But when we're looking, over a 5 year period, you're always going to win out when it comes to housing and when it comes to properties. So it does get you into the housing market and allows you to start building that equity soon. Now, are there cons? Absolutely. If you're putting as little as 5% down, there's some high premiums, right? And 4% is a large amount. So that's going to be money that's going to be added to the premium of your mortgage, right? So if you're buying a house for whatever number that is, if you're putting if you have a 95% loan to value and you're only putting 5% down, that 4% premium is going to be added onto the mortgage. So it's going to make it tougher to get out of. If a year down the road you need to get out of that mortgage for any reason, you have a very small little area of equity there, right? There's not a lot of equity. There is a higher cost of borrowing, right? Like you have that higher insurance premium. There is a higher cost of borrowing. The biggest one, very strict guidelines, right? So if you are at 1% over on your ratios, even 0.01% over on your ratios, if your credit score is a little bit under, they're very strict, right? There is no exceptions. You need to make sure that you fit right in there. So those are some of the pros and some of the costs some of the pros and some of the cons of a 20% down mortgage versus as little as a 5% down mortgage and using an insured deal. So pros, cons, like I said, if you have 20% down, use it, right? If that's available, definitely use that money right there. If you only have 5% down, don't chase your down payment. Don't chase it for years and years and years. Like I said, it's going to continue to go up. If you are looking to buy and you have more questions and you want to build a budget out for yourself, give me a call, shoot me a text, or go ahead and book directly on my calendar. My team and my preferred partners will give you the local competitive advantage in today's real estate market. I look forward to chatting with you.